Hello, today is Monday, the 3rd of March, 2008. This is Brian Shannon from Alpha Trends. The markets closed and the S&P 500 finished with a loss of 50 cents or 0.37%. It was a pretty choppy session. Seemed like they were going to, trying to break them hard. But I think that the weakness of the prior 3 days kind of had the sellers a little bit exhausted in here, and we weren't able to really get much follow through to the downside. As again, it looked like it had the potential to really get hit hard. It did. The S&P 500 did break this little uptrend line that we've been looking at the last couple days. However, it still remains above that key level of 132, and I think that breaking the 132 is really what it's going to take to get this market to go into kind of the give-up stage, where we can start to consider a test of the lows from back in January. So these lows are still looming, I think, as far as a potential test. It's just a matter of when, I think, more likely than if. We've got the declining 5-day moving average that tells us that any rally that might develop out of here should not be trusted, and if you are going to trade, attempt to trade anything on the long side, I still think you got to stick to a 1-minute time frame or so. You look at the daily today's daily action here with this 1-minute VWAP, and you can see that it was a pretty choppy back and forth action. It seemed here as though maybe the sellers were going to be able to push this thing lower, and we had a nice downtrend for a while, but then as that market made this first higher low and then a higher high here, that was your signal to cover shorts for the short-term trade. Longer term, it's still, the market's still a mess. It's still in a horrible downtrend. Early on, we tend to find resistance at the short term, then the intermediate term, then the longer term moving averages, as we see the short term act as support, the intermediate, then the longer term. So it looks like we may get a little bit of a rally here. I think you want to back off being super aggressive on the shorts. I'd like to see a rally perhaps up towards somewhere maybe near 135.5 or so. This 5-day moving average may come down and meet the market at that level, but it seemed like if they were going to break it lower, today was the day to do so, and maybe we just get a little bit more action within this overall range, which again is at 139.80 or so, down towards that 132 level. So if we can get, even if we take a look at Fibonacci and say maybe we'll get a 50% retracement of this sell-off, that would bring us up to 135.80 or so. A 1/3 retracement, or 38.2%, would bring us up to about 135. So maybe we get a rally up towards 135, 135.5. But still, this market is in bad shape. One look at this weekly time frame, tells you that if you're trading from the long side on the average stock in the S&P 500, in expecting lows to be found, I think you're fooling yourself, and the odds just obviously aren't there for it. What I mentioned today on my blog was this. The IRX is the 13-week T-bill index, and this kind of seems to lead the financials, and then the financials kind of seem to lead the rest of the market lower as well. This is basically the T-bill index, and I'm not sure that I really am qualified to comment on what it is, but my belief of what it is it represents the ease of liquidity for T-bills, basically. And as this goes down, then there's really not much liquidity in the T-bills, further, putting more weight on the mortgage market and that sort of thing. And the interesting thing was that it seemed to break down, about 1 p.m. or so this afternoon. I'm not sure if there was reason for that, but obviously Thornburg today blew up. And again, stay away from these financials. They are, just accidents waiting to happen. Let's take a look at the financial index, the XLF. So by the way, if anyone really has a good description of what that T-bill index is and how we might want to analyze it, or if you've got a blog or something you want me to link to that has a good description, then shoot me an email. I don't want to read a long description, but I will provide that link on my site. The financials, rather, these guys, again, they broke below the $26.20 level that we were looking at late last week, and continue to drop lower along the path of least resistance. I don't know what's wrong with my words here today. But short term, we do have a higher low that was made this afternoon. If this market gets above the this resistance here that formed today at about $25.70, then maybe it's going to make a run up towards that 26.20. I would expect that would be an area where we would find some resistance. So this market's still broken. I still expect that we will see a test of this level at the minimum and probably lower lows. That seems to be the message being broadcast by the T-bill index as well. So the financials remain a very troublesome area for this market. The Russell 2000 was down 62 cents, or about 0.1%. You see here a nice late day recovery as it got back up above that key level of $68 that we've been looking at. So again, I've been mentioning the importance of this $68 level for several weeks now, and the point I want to make here once again is it's not the breaking of a support level that matters most, but the subsequent action. Do the buyers come in and rescue the market? And they seem to have, at least for today, have rescued it there. And again, I'm going to say that the typical breakdown through support, which leads to a complete give up, usually doesn't occur after we've seen a quick and violent downside move like the one that we've seen over the last 3 days in the Russell 2000. So with the more likely scenario for a breakdown that leads to the test of the lows is a rally up in here that kind of makes people think, well, that was a unsuccessful break, so maybe we get a third to a half retracement. It comes up towards that declining the 5-day moving average. Boy, I'm just not talking good today. But maybe we get it to move up to that declining 5-day moving average. That 5-day moving average might come down to meet it, and then we see further downside. So again, in here, I'd say I want to back off the aggressive short side for now, but the path of least resistance is clearly lower, and it just seems inevitable that we get a test of these lows down near 64. Finally, the NASDAQ 100, the Qs did break this uptrend line that we'd been monitoring here, that was based on that symmetrical triangle. So this market never was able to make the higher high after breaking the down trend, but here today it did make a lower low, and it did recover back above that level. So short term, it looks like maybe we get a little bit of a bounce, but again, to try and trade it, I think only the most aggressive traders ought to be involved in that. The market remains in a severe downtrend. The average buyer of the Qs since the 75 basis point rate cut and the 50 basis points after that has been at about $44. So on average, the average person who's long this market is losing money. The average short since the Federal Reserve is gaining money. So the shorts are going to defend that their profitable positions by offering more shares out when the market gets vulnerable, and to try and scare those long holders out, because clearly the emotional players in this market tend to be more on the long side right now, as fear is very high in this market at this point. So continue to be careful. Not much has really changed. I would say the theme for today is that the market wasn't able to flush lower. Maybe we get a little bit of a stabilization in here for a day or two, but I still expect a test of those lows, so danger remains very high.